Welcome to our deep dive into the world of derivatives. Wow, you've given us a fascinating mix here, from academic textbooks to real-world market analyses.
Yeah.
So our mission today is to cut through the jargon and give you a solid understanding of, well, really, what derivatives are, how they work, and why they matter.
You know, it's really interesting because derivatives touch so many parts of finance.
Yeah.
From managing risk to, making those calculated bets on where the market's heading.
Okay, so let's start with the basics. What exactly is a derivative?
Mm.
It's not like, simply buying a stock or a bond.
Right.
Right?
You're absolutely right. It's not that straightforward.
Okay.
Derivatives are financial instruments that basically get their value from something else. We call it the underlying asset.
Okay.
Think of it like maybe betting on a sports game.
Okay.
You're not buying the team itself. You're just wagering on how they'll perform.
That makes sense. So instead of directly owning a stock, I could have a derivative that goes up in value if I think that stock is going to go up.
Exactly. You've got it. And, there are all these different types of derivatives, each with its own, little quirks and characteristics. We've got forwards, futures, options, and swaps, all covered in the material you gave us.
Perfect. Let's tackle those one by one. The sources mention forwards as being the simplest kind, almost like a vanilla version of a derivative.
Yeah, they really are. They're the most basic form.
Okay.
A custom agreement between two parties to trade an asset at a predetermined price on a future date. One example that really stood out from the materials was a forward contract to buy an apartment. Let's say you want to buy it a year from now, and right now it costs, say, NOR S, $10,000.
Okay, so I could lock in a price today with the seller, say, or S 14,000 to buy it a year from now.
Right.
Even if the prices go crazy high in the meantime, that sounds like, a pretty good way to avoid getting priced out.
Precisely. You hit the nail on the head. You'd be protected from those, unexpected price increases. But there's a flip side to consider too.
What's that?
If the market price takes a dip and drops below that R's 14,000 in a year, you're still obligated to buy it at that price you agreed on.
Ah, so there's a potential for loss, too. It's not just a one-way street to profit.
Exactly. It's a two-way street. Forwards can be used to, hedge against those price increases, but they can also be used for speculation, betting on which way the prices will swing. That's actually a common thread you'll see with many derivatives.
Makes sense. Now, the sources dive into futures, and at first glance, they seem kind of similar to forwards. What's the key difference?
So the big difference is that futures contracts are standardized and traded on exchanges.
Right.
Unlike forwards, which are customized. That standardization means they have these set terms like the quantity and the quality of the asset. And being exchange traded, that adds transparency and reduces risk.
Okay. The materials mention all these features that are unique to futures. We've got the standardization, the exchange-traded aspect, margin requirements, daily settlement. It's a lot to unpack.
It is. Yeah, let's break it down a bit. We've already touched on standardization, right?
Yeah.
And how trading on an exchange makes things, a bit more transparent. But then you've got margin requirements.
Okay.
And this means both the buyer and the seller have to deposit a percentage of the contract's value with the exchange. It's kind of like a guarantee that they can cover potential losses.
So it's not like I need to, cough up the entire amount up front.
Exactly. No need to shell out the full amount right away.
That's good to know.
And then we have daily settlement.
Okay.
This means every single day your account is adjusted for any profits or losses based on that day's closing price of the futures contract, even though the actual delivery of the asset might happen much later.
I see. So that keeps things in check, I suppose, instead of waiting until the very end to figure out how much you've won or lost.
You got it. It's all about keeping things balanced along the way.
And speaking of winning and losing, your materials actually had this great illustration with a textile manufacturer and a farmer entering into a cotton futures contract.
Right. A classic example to show how these things play out in the real world.
Yeah, that one really stuck with me. The manufacturer needs to buy cotton in the future, right?
Yes.
And the farmer, they want to sell. So they agree on a price today through this futures contract. But of course, the market price could totally change by the time the actual exchange happens.
Exactly. It's all about managing that uncertainty.
So if the cotton price goes up, the manufacturer who locked in that lower price through the futures contract, they're happy, right?
Absolutely. They're protected from that price increase.
But on the flip side, the farmer who, well, they could have sold at a higher price in the open market. They actually end up taking a loss.
Right. It can swing both ways.
But it could go the other way too, right? I mean, if the market price of cotton drops, then the farmer's the one who wins because they locked in a higher selling price. So it really just depends on which way that price moves.
You've got it. It all boils down to the price fluctuations in the market.
So beyond just, understanding how these futures contracts actually work, your sources highlight that tracking something called open interest, that can be a valuable market indicator.
Yeah, definitely. Yeah. Open interest can be a powerful signal.
Open interest. Can you refresh my memory on exactly what that is?
Sure. Open interest is simply the total number of those outstanding futures contracts for a particular asset. So, a high open interest usually signals really strong interest in that underlying asset, while a declining open interest could point to maybe waning interest, or even a potential shift in the market.
So it's kind of like gauging the crowd's excitement at a concert?
Exactly. A great analogy.
A packed house means there's buzz, but if people start leaving early, that could signal something's off.
Exactly. You're reading the room.
And to connect this back to your materials, think about the example of the Nifty Index's bull and bear phases. Remember the cost of carry? Or COSI.
Well, the COSI, a key concept to understanding futures markets.
Right. So the COSI is essentially the difference between that futures price and the spot price of the underlying asset.
Precisely. And during a bull market, when everyone's optimistic, the COSI tends to be higher.
Okay.
Reflecting that optimism, right? And that willingness of traders to pay a premium for those futures contracts.
Right.
But then, in contrast, during a bear market, the COSI is lower because pessimism takes hold.
So analyzing the COSI, like alongside open interest, can give traders a real sense of the market's mood beyond just looking at the price of the asset itself. That's pretty clever.
It's about, uncovering those hidden signals within the market. And that actually brings us to options. And your sources rightly point out that these are, they're quite different from futures.
Okay.
With options, you have the right, but not the obligation, to buy or sell an asset at a specific price.
So options sound a bit more flexible than futures, wouldn't you say? You can choose to exercise your right if it's profitable, or just walk away if it's not.
Exactly. You have that flexibility, that choice.
Yeah.
And there are two basic types. We've got call options, which give you the right to buy, and put options, which give you the right to sell.
Okay. Now, the materials also mention this intrinsic value and time value when they're talking about options. Those kind of trip me up a bit.
Yeah, they can be a little tricky to grasp at first.
Can you clear that up for us?
Sure. So intrinsic value is basically what an option is worth right now. Like if you were to exercise it immediately, it's just that difference between the current market price of the asset and the options, what we call the strike price, the price you can buy or sell at. Now, time value, on the other hand, is all about potential. It reflects the possibility that the asset's price could, move even more in your favor before that option expires.
Okay. So the longer I have until the option expires, the more time value it has, because there's just more time for that price to shift in a direction that benefits me.
Precisely. Time is literally money when it comes to options.
Okay. Now here's where it gets interesting. The sources say it's often better to sell an option than to actually exercise it because of what they call time value decay.
Yeah, that's a bit counterintuitive, isn't it?
It is. It really is. Why wouldn't I just exercise my option if it's, already profitable?
Well, think of it this way. When you exercise, you only get that intrinsic value, but you're giving up any remaining time value. By selling the option, you're essentially capturing both those values, which could potentially lead to more profit.
So it's like selling a concert ticket when the demand's super high rather than waiting until the day of the show when, its value drops.
That's a great analogy. You got it.
To fully understand this whole potential profits and losses thing, we need to look at what the materials call the payoff profiles of both call and put options.
Yes, exactly. Those payoff profiles can really clarify things.
The sources actually use these tables for Reliance and Party Airtel as examples.
Yes. Those tables are very helpful for visualization.
They are helpful, but can you kind of walk us through them?
Of course. So let's take that Reliance call option with a strike price of, say, RS 2,250.
Okay.
Now, if Reliance's stock price at expiry is below that RS 2,250, the option is basically worthless, and you lose the premium you paid to buy it.
But what if the Reliance stock price just takes off and goes way past that RS 2,250?
then you're in the money. Your profit increases, it increases by a rupee for every rupee the stock price rises above that Rs. 2,250, minus, of course, the premium you initially paid for the option.
So there's like potentially unlimited profit, right?
Yeah.
Because the stock could theoretically just keep going up and up.
Theoretically, yes. But keep in mind, your maximum loss is always capped at that premium you paid.
Okay, so it's an interesting trade-off. Potentially unlimited profit on one side, but a limited loss on the other.
Exactly. It's about assessing that risk-reward balance.
Now let's look at that Bharti Airtel put option with a strike price of R760.
Okay.
So if the stock price is above that R760 at expiry, I lose the premium, right?
Right. If the stock price doesn't fall below your strike price, the put option doesn't have any value.
But if the price drops below R760,
then the put option becomes valuable, and your profit grows as the stock price falls even further below that R760 mark.
I see. So with the put option, my profit grows as the stock price falls, but unlike the call option, it's capped, right? Because a stock can't go below zero.
You're absolutely right. Your potential profit with a put is capped at the strike price, that R760 in this case, minus the premium.
Okay, so maximum profit is limited, but my maximum loss is still just the premium I paid.
Exactly. It's all about understanding those boundaries.
Okay, those payoff profiles really make the potential risks and rewards a lot clearer. But as your sources point out, there's a whole bunch of factors that can influence option prices. It's not just about, guessing whether the stock will go up or down.
You're absolutely right. It's way more nuanced than that. Factors like the underlying asset price, the strike price, time to expiry, volatility, interest rates, even dividends, they all play a role.
Right. Volatility, that's one word that keeps popping up in the materials.
Volatility is key when it comes to options.
I mean, I get that it means how much an asset's price jumps around, but why is it so important, especially for options?
Well, the more volatile an asset is, the wider its potential price swings can be.
Right? Yeah.
And that means there's a higher chance for those, those big profits or big losses with options.
The example they used calculating Reliance's daily price changes back in May 2009, that really drove that point home for me.
It really highlights the power of volatility in action.
Yeah.
It shows how we actually measure that historical volatility. And in general, higher volatility tends to mean higher option prices, simply because there's more potential for the price to move, significantly in your favor.
So if I'm expecting, a wild ride with a particular stock, I'd need to pay more for an option on it because that potential for wildness is valuable to options traders.
Exactly. They're factoring that volatility into the price.
And this brings us to what your materials call the fear index, the VIX.
Ah, yes, the VIX. It's a fascinating indicator.
I'm all ears. What is this fear index?
So the VIX basically measures that implied volatility, but in the S&P 500 options market.
Okay.
So it's reflecting how much the market expects prices to swing in the next 30 days. And a high VIX indicates high expected volatility, which is often associated with, fear or uncertainty in the market.
So even though it's based on the U.S. market, a spiking VIX is kind of like a global warning sign that things might get a little rocky.
You could definitely interpret it that way. It reflects the interconnectedness of the global markets. Now, beyond volatility, the options strike price also has a big impact on its price.
Right. Okay. Can you remind me how the strike price comes into play again?
Sure. So the strike price, remember, it's that price you can buy or sell the underlying asset at.
Yeah.
With call options, the lower that strike price is, the higher the option price will be because it's simply more likely to end up in the money, meaning, the market price is above that strike price.
So with put options, it's the opposite.
Yeah.
A higher strike price makes it more likely to be in the money if the market price drops below that strike?
Precisely. You got it. And of course, the time to expiry also matters. Longer expiry generally means higher option prices because, there's more time for those favorable price moves to happen.
Makes perfect sense. What about interest rates? How do those affect things?
Good question. So higher interest rates generally tend to make call options more expensive and put options a bit cheaper. It's all about the opportunity cost of holding the asset versus the option.
Okay, that's getting a little complex, but I'll trust there's a good logic behind it.
Oh, there definitely is. It's a fascinating interplay of financial forces.
And lastly, we have those dividends. How do those come into play?
Well, dividends usually have a downward pressure on call option prices and an upward pressure on put option prices.
Okay.
Because, when a company pays out a dividend, its stock price usually dips just a little bit.
So we've got volatility, the strike price, time to expiry, interest rates, dividends. It's like this whole recipe for option pricing with each ingredient playing a specific role.
A very complex recipe. And to make things even more interesting, real-world events, those corporate actions, can really shake things up in the derivatives market.
Right. The materials were packed with examples. They talked about ABB's stock split, TCS's bonus issue, TV18's rights issue, and especially that Reliance Petroleum and Reliance Industries merger.
Oh, yeah, a classic case study of how corporate actions can impact derivatives.
And those examples really highlight how things like stock splits or mergers can actually impact those derivative prices. And, they sometimes require adjustments to those existing contracts.
Exactly. It's a reminder that derivatives are they're tied to what's happening in the real world, not just those abstract market movements.
Very true. Now, this brings us to the exciting world of, trading strategies, using derivatives to achieve different goals.
Strategies, that's where things get really interesting.
All right, let's get strategic then. The sources mention, they mention hedging, speculation, and arbitrage as the three main approaches.
Those are the big three when it comes to using derivatives strategically.
Okay, so first we've got hedging.
So hedging is basically about using derivatives to offset those potential losses you might have in an underlying asset.
Okay.
It's like insurance for your investments. And they had a good example with that Reliance portfolio hedge, using futures.
Right. If you own Reliance shares and you're, worried about a market downturn, selling Reliance futures can kind of cushion the blow if the stock price drops.
Oh, exactly. You're creating a counterbalance. Your portfolio might lose value on those shares, but you gain on those futures contracts, which helps to even things out.
So it's a way to, manage risk and, protect yourself from those big losses.
Exactly. Hedging is all about managing risk.
Okay. Now, speculation. That sounds, it sounds a little bit riskier, wouldn't you say?
It can be, yes. Speculation's about, making a calculated bet on where the market's going. So it involves using those derivatives to actually profit from those price movements, rather than just hedging against potential losses, like in that example they gave, speculating on the Nifty index using futures.
Right. So if I think, the Nifty's going up, I could buy those Nifty futures and then profit as that futures price rises.
Yeah.
But if it goes down, well, then I'm on the hook for those potential losses.
That's the trade-off with speculation.
Yeah.
Higher risk, but also higher potential reward.
Okay. And lastly, we have arbitrage. What is that all about?
Arbitrage is all about exploiting those price differences. They happen in different markets. And, the goal is to make a profit from those differences.
So you're finding these, these little mismatches in the market.
Exactly. Like that fascinating example with DLF where the stock price was actually lower in the cash market than it was in the futures market.
Right.
That's a classic arbitrage opportunity. You buy the DLF stock in the cash market and then simultaneously sell those DLF futures contracts, and you lock in a profit from that price difference.
So it's like finding a loophole in the market and then making a quick buck before it disappears.
It's about exploiting those inefficiencies that pop up from time to time.
Now, before we get too carried away with all these profit-making strategies, we have to talk about risk management.
Oh, absolutely. Risk management is absolutely crucial in this world. Your sources are very clear about that.
Yeah, it makes sense. We're dealing with some powerful tools here. And as they say, with great power comes great, the need for great responsibility, right?
Couldn't have said it better myself. We really need to understand these concepts like value at risk or VAR, which it helps us estimate those potential losses on a portfolio.
Right. They went through the process of calculating Reliance's VAR. They used historical volatility, and the results were, pretty eye-opening.
It can be quite startling to see how much an asset's price can swing, even when it seems stable.
Yeah.
But that's why VAR is so important. It helps us set those limits and really understand our risk appetite.
It's like a speed limit for our portfolio, telling us how much we're, comfortable losing before we need to hit the brakes.
That's a great way to think about it.
Okay, so how do exchanges actually manage these risks in the real world?
Well, they use these margining systems.
Okay.
The initial margin is basically that upfront deposit you make when you enter into that derivative contract. But then you have what's called mark-to-market margin. And that's the daily adjustment of your account based on those market price changes.
So the initial margin is like a a safety deposit. And the mark-to-market margin keeps that deposit topped up as the prices go up and down.
You've got it. It's all about maintaining that buffer against potential losses.
Okay. And then there's span margining, right?
Right. Span margining is even more robust. It looks at the overall risk of your entire portfolio of derivatives, not just, those individual contracts.
So span margining is like a stress test for your portfolio, right?
Right. Exactly. Make sure you can handle those, those big market swings that can happen.
Okay.
But, beyond all those calculations and complex systems, your sources really emphasize the importance of having really robust back-office systems.
Yeah, they walked us through that scenario of a broker, managing all these different client trades, and it was clear that you need sophisticated software.
Oh, absolutely.
And skilled people to keep track of everything. It's pretty mind-boggling.
It really is. It's a very complex ecosystem behind the scenes, but it's essential for ensuring that the derivatives market functions smoothly.
Okay, so we've covered a ton of ground already.
We have.
From those basic types of derivatives to the strategies for using them, and that vital role of risk management.
A lot to absorb.
It is. It is. So what else do we need to explore to really, to really master this world?
Well, we've still got more to uncover. We need to delve into this whole clearing and settlement process, the mechanisms that ensure those smooth transactions. And then we need to tackle accounting and taxation, those practical considerations that can really impact, our bottom line.
You're right. It's not just about understanding the mechanics of derivatives. It's about navigating those real-world systems and regulations that govern them.
Exactly. So let's dive into clearing and settlement. Your sources dedicate a big chunk to the role of clearing houses in, guaranteeing the settlement of derivative trades.
Yep.
They're like the referees, making sure everything's fair.
That's a great analogy. They really are like referees.
Yeah.
Clearinghouses act as these intermediaries between the buyers and the sellers, right? And that really helps to mitigate that counterparty risk.
Right.
The risk that one party might not fulfill their obligations.
Right. So they essentially guarantee that those trades will be settled, even if one party, defaults.
That's reassuring, so I don't have to worry about the other side of the trade, just disappearing with my money. But how does this whole clearing process work? Your sources mention these trading members and clearing members.
Right. So trading members are basically they're the brokers.
Okay.
They execute trades for their clients. You can think of them as like the players on the field. Then you've got the clearing members. They're the ones responsible for clearing and settling those trades. They ensure that all the obligations are met and funds are transferred correctly. They're more like the referees, making sure that the game runs smoothly.
Okay, so the trading members are facilitating the trades.
Yes.
And the clearing members are guaranteeing that settlement. It's like a system of checks and balances that, it really instills confidence in the market.
Exactly. Checks and balances are key. And to illustrate this process, your sources, they walk us through this hypothetical scenario of a broker managing those client trades. Really highlights that need for robust back-office systems.
Yeah, it's a good reminder that there's a whole lot going on behind the scenes to make sure everything runs smoothly. They gave us a little peek into that complex world of margin calculations, trade confirmations, settlement procedures. It's a lot.
It's fascinating how much goes on, behind the curtain to ensure that the derivatives market is both sound and efficient. And these processes, while they might be complex, they're really crucial for maintaining that trust and stability.
Absolutely. It's like this, like a well-choreographed dance. Every step is carefully planned out and then executed.
It really is a well-oiled machine.
Your sources also, they outline those specific settlement processes for both futures and options, highlighting those differences between index derivatives and those individual security derivatives.
They did. And they also emphasized the financial stability of those clearinghouses and clearing members. They're really a critical component of the whole system.
Right. They mentioned things like, minimum capital requirements for clearing members and the maintenance of clearing funds to cover, potential losses. It's like having this safety net to make sure that even if one party stumbles, the system as a whole, it stays strong.
Exactly. Those safeguards are there to maintain confidence in the market, to ensure that things keep running smoothly. Now, shifting gears a bit, let's talk about those accounting and taxation aspects of derivatives, a topic that's often overlooked, but it's incredibly important.
It is important. Those practical considerations can really make a difference when it comes to our, to our financial statements, and of course our tax liability. Your sources provide a good overview of how we account for futures and options under Indian accounting standards.
They did a good job of, laying out the groundwork.
Yeah.
Highlighting those key principles, like recognizing gains and losses appropriately, distinguishing between that business income and speculative business, and understanding that special carve-out for exchange-traded derivatives.
Right. And for those of us who, we operate in a more international context, they also they gave us those insights into the accounting treatment under the International Financial Reporting Standards, or IFRS.
Right. They delved into those areas like hedge accounting, fair value measurement, the recognition of gains and losses, and they pointed out some of those key differences from the Indian accounting standards.
It's interesting how these global standards are, they're trying to harmonize those accounting practices, but they also recognize that there are those regional nuances.
It's a delicate balance.
It is. It really is. And it shows that the derivatives world is truly global.
It is.
With those interconnected markets and regulatory frameworks, it's not just about what happens in India. It's about understanding that broader financial landscape.
Exactly. A global perspective is essential. And speaking of understanding that broader landscape, I think it's worth circling back to those market indicators that we touched on earlier. They offer such valuable insights into that collective psychology of the market. It's almost like, it's almost like being able to read the market's mind.
Ooh, I like that. It's about going beyond just those numbers on the screen, right? And understanding the emotions, the fears, the hopes. Those things that actually drive that market behavior.
Precisely. It's about understanding the human element behind those market movements.
Okay, so let's remind ourselves. We've got open interest, the cost of carry, implied volatility, and that put-call ratio. Those are the clues, right?
Those are the key indicators, yes. The ones to watch.
They're like those subtle cues in a poker game.
Exactly. The tells that can give you that edge.
Right.
And the more we understand these indicators, the better we can navigate this complex world of the derivatives market.
Okay. Now, before we wrap up this part of our deep dive, let's talk about one more type of derivative that people might encounter: swaps.
Swaps. We haven't touched on those too much yet.
We haven't. So what are they all about?
So swaps are basically these agreements between two parties to exchange cash flows or liabilities based on certain conditions. They're very versatile. You can use them for all sorts of purposes, like managing interest rate risk or even currency risk.
Can you give us a real-world example of how a swap might actually be used, just so we can picture it?
Sure. Imagine a company, right? And they've borrowed money at a floating interest rate.
Okay.
But they want to protect themselves from those potential, those interest rate hikes that can happen. So what they could do is they could enter into an interest rate swap with another party.
Right.
And they essentially exchange their those floating rate payments for fixed rate payments.
So they're basically they're swapping out their exposure to those to those interest rate fluctuations.
Exactly.
They're getting more certainty in their cash flows.
Precisely. It's about managing that uncertainty.
Okay. So swaps can be they can be pretty complex, but they sound like a powerful tool for managing different types of financial risk.
They are. They're a very versatile tool in the derivatives world.
Okay, so we've got forwards, we've got futures, we've got options, and now we've got swaps.
The whole toolkit of derivatives.
It is. Each with its own, its own quirks and applications. It really is a diverse and fascinating world. It really is a diverse and fascinating world. We've covered so much in this deep dive, from those basic definitions and types of derivatives to those sophisticated trading strategies, and of course that crucial role of risk management.
Yeah, we've been through a lot.
We have, and we've even started to decode those mysterious market indicators. But there's one final piece of the puzzle that we need to look at.
Outside.
Accounting and taxation.
Mm.
The sources you provided, they dedicate a whole section to these, to these practical concerns, and it's clear that they can have a big impact.
Oh, absolutely. Understanding how those derivative transactions are actually accounted for and, the tax implications, that's essential for making those smart decisions and, making sure we're in compliance with all those regulations.
Right, right. The materials start by explaining the accounting treatment of futures and options under the Indian accounting standards.
Right,
It
right.
can seem a bit dense at first, but they do a pretty good job of breaking down those key principles.
Yeah, they lay a good foundation, highlighting those important points like recognizing gains and losses correctly, distinguishing between that business income and speculative business, and understanding that special treatment for those exchange-traded derivatives.
Right, right. And for those operating, in a more international context, the materials also they provided those insights into how derivatives are handled under the International Financial Reporting Standards, those IFRS.
Yeah, those global standards are important to consider too.
They are. So they explained how IFRS addresses those issues like hedge accounting, fair value measurement, and the recognition of gains and losses. And they even pointed out some of those key differences from the Indian accounting standards.
It's interesting to see how how those global standards are trying to harmonize those accounting practices.
Yeah.
But they also acknowledge those regional differences.
Right. It really it underscores that point that the derivatives world it really is global.
It is, very much so.
With those interconnected markets and those regulatory frameworks, it's not just about what happens in India. It's about understanding that broader financial landscape.
A global perspective is really essential.
It is. Okay, so as we wrap up this deep dive into the world of derivatives, what are your key takeaways for our listener? What are the most important things to remember as they kind of embark on their own journey into this fascinating and complex field?
Well, first and foremost, I think it's crucial to understand that the derivatives are powerful tools.
Yeah.
They can help us manage risk and even amplify returns.
Right.
But they're not magic. And they certainly come with their own risks.
Right. It's not about getting rich quick. It's about making those informed decisions, based on a solid understanding of how these things work, the factors that influence their prices, and those potential pitfalls to avoid.
Exactly. And it's about choosing the right derivative
Right.
for the right situation, whether you're hedging against those potential losses, speculating on those market moves, or maybe taking advantage of those arbitrage opportunities.
And we can't forget about risk management. That's absolutely key. It's not just about understanding the potential for profit. It's about having a clear plan for managing those potential losses too.
Absolutely. Knowing your risk tolerance is crucial.
Mm.
Setting those appropriate limits, using those tools like VAR and those margining systems. That's all essential for navigating the derivatives market, safely and responsibly.
And finally, I think it's important to remember that the world of derivatives, it's constantly changing.
Oh, it is.
New products, new regulations, technologies transforming the way we trade.
It's dynamic. It's exciting.
It is.
And those who stay, curious, informed, and adaptable, they're the ones who are going to be best positioned to succeed.
Well said. So to our listener, we encourage you to keep exploring, keep learning, keep asking those questions. The world of derivatives, it is vast and complex, but with a solid foundation and a thirst for knowledge, you can really unlock its potential and achieve those financial goals.
And who knows, you might even find it a little bit addictive.
I have to admit, there's a certain allure to it.
There is.
Well, on that note, we'll wrap up this deep dive into derivatives. Thanks for joining us on the deep dive. We'll catch you next time for another fascinating exploration of knowledge.